Hello, everyone. My name is William Mucker. I'm a client executive with Camaplan and would like to thank you all for joining us for today's webinar, 3 Factors to Help You Invest Intelligently in Real Estate with Denise Piazza, Managing Partner of One Street Capital. I'd also like to thank you for joining us today, Denise, to provide us this education. As a quick note, please be aware that Denise will be answering questions at the end of the presentation. However, feel free to use the Q&A function on your screen, not just the chat, to pose your questions whenever they cross your mind. Just be aware they will be addressed when the presentation portion ends and the Q&A portion begins. Before we get started, we have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of that dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open the account, fund that account, and facilitate the transaction into that investment. Here is my contact information. If you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction, please do not hesitate to contact me. I'll be more than happy to help you. And without further ado, I'll pass the controls over to you, Denise.
Great. Thank you so much. Well, I appreciate it.
Of course.
Okay, let me just pull up my presentation. Okay, well, just confirming you can see my screen.
Yep, looks good.
Okay. All right. Well, thank you so much again for having me. My name's Denise Piazza. It's nice to chat with Will again. I actually had him on a webinar series about a few weeks back now. So nice to be here. I think many of us are here and we work with Camaplan because we are interested in investing in real estate and alternative assets. Most of us probably recognize the tax benefits associated with these types of assets, the inflation hedge it provides, and above market returns when we're investing in this asset class. But I'm here to talk to you about today how we can feel more comfortable that we are investing intelligently in real estate and other alternative investments, given all the options that are out there across multiple asset classes and opportunities. So just a bit about me. I have really started working with the real estate industry over 20 years ago now. Basically when I was employed at a CPA firm, I started working with a lot of high net worth clients, being a CPA and doing a lot of their tax returns. And one common denominator that I noticed across the portfolio of many of my clients at the time were real estate investments and real estate holdings. And so at the time, I didn't have the liquidity needed to invest at that point in time. However, I knew that it was something that I wanted to eventually have in my portfolio. So fast forward years after that, my husband and I started investing into real estate. We invested across multiple asset classes. Basically a few of the asset classes were single family homes. We had invested in some triple net leases, some in, office, we purchased some office space, and ultimately a lot of multifamily or apartment assets over that point in time. So, I've held several accounting and finance positions over the past 20 years. But again, one of those key factors that I wanted to make sure that when I invested into real estate, or that I was going to eventually have a portion of real estate holdings within my portfolio. We are now invested, we've actually participated in over $250 million worth of real estate transactions. I'm very happy about that and have learned a lot over those experiences. And that's really what I'm here to talk to everyone about today. So again, once you make that decision that you think real estate is an attractive asset class, how do you ensure that you're doing things in the proper order and basically with vetting various investments? And what are the steps that you should take after you decide that you want to be a real estate investor? So the first step that I think someone should consider when they're deciding to invest into real estate assets is evaluate your own personal investing goals. Now, I say all this when I'm just as guilty of not doing this. When we first started investing into real estate, I was so excited to jump in and to take advantage of the opportunity for tax benefits that I don't think I stopped and thought about what my own personal investing goals are. And I know a lot of us, we start working in a salaried position, or we have a business and you start pumping money into your 401k. Maybe you have some money in the market. Maybe you've done some, real estate investing as well. But a lot of us don't take a step back and think about what our overall investment goals. So the first one that I think you should really consider when deciding whether or not how you want to invest into real estate is, are you more focused on assets and opportunities that provide higher cash flows and maybe less appreciation potential? Or are you more invested in, want to be invested in opportunities that have a higher velocity of returns of your capital? And so what I mean by that velocity of return is that basically you put your money into an investment opportunity. Maybe you invest in an industrial property as a limited partner, and you're more interested in getting your capital back as quickly as possible so that you can redeploy that capital and focus on overall wealth accumulation. And so, with that, those types of projects, they might not be as high of a cash flow basis, but they have more opportunity for appreciation and a higher overall rate of return on the investment. So, again, going back to the cash flow versus the returns, the higher overall returns, one example of someone who might be more focused on having that higher cash flow would be someone who's only working on who works on real estate, has a real estate portfolio. Maybe they're a single family home acquirer, maybe they do some fix and flips. And so they're focused a lot on in their investments into other real estate opportunities with higher cash flows. Or maybe you're at a point in your career where you're a salaried employee and you're just, or you're a business owner and you're looking to grow and accumulate your wealth. And with that being the case, maybe you would consider opportunities that have that higher, that shorter hold period and that higher overall return on the property itself. The next thing you should do is really, before you dive into any sort of real estate investing, is look at your overall portfolio, how much savings you have, how much you have across your entire portfolio, including any properties, and figure out what percentage allocation you want to have tagged towards a real estate investment. And knowing that percentage will help you anchor to an overall total funds that you want to have in these types of opportunities, and keep you grounded for looking at how much you want to invest in each and every opportunity that you are motivated by. And the next one I would say is to know your risk tolerance. There's a lot of different asset classes, which we'll touch on, a lot of different property types, overall investment goals and opportunities. And what you want to know is what is your overall risk tolerance towards each investment that you have. So one example might be that when you have a little bit more risk associated with the deal is if you do an investment in a ground up development property. So that particular investment might have a higher risk and might not be aligned with your overall risk profile. But, one thing that we see with those types of assets is it has a higher risk, but as an investor, you're typically compensated with a higher overall return, given the risk associated with those assets. And last but not least, I like to remind people to ensure that you discuss your overall strategy and your investing goals with your significant other, if you have one, and make sure you're aligned with your strategy. It's really helpful when you sit down and you go over, it's not exactly the most exciting Friday night, but when you go over your portfolio and how much you have, and when you talk to your spouse about the types of opportunities you want to take a look at and the returns and how they're aligned with your overall wealth accumulation goals. The next thing that an investor should look at is, and that can be overwhelming when trying to figure out how to invest intelligently in real estate, is all the different asset classes that you have available to you. So I've listed some of the more renowned asset classes on this slide. Basically, these are the ones that I see more often than not in our real estate offerings. And so there's risks and rewards associated with each type. Some of them I've listed here on this slide. A lot of people start out investing in real estate with single family homes. I purchased one myself with my husband over 10 years ago. But basically, one thing that I looked at from my perspective and where I was in my investment journey is it was easy for us to get started with that asset type, but it took a lot of my time. So I realized that I wanted to be a little bit more passive in my real estate investments, similar to how I am in other portfolio holdings that we have. And that really prevented me from the type of tenants and the type of properties that we had, really prevented me from having more of a passive investment. Some of the others that we've purchased and looked at over the years are office buildings. We currently have ownership in an office building. I always like to tell people that it is fully occupied. I know with the COVID time frame, it was, there was a lot of people working remotely. And I still think right now, this is an asset class for me personally, that it has a higher level risk than what my overall risk profile tolerates. And so with the oversupply and the hybrid remote work risks, it's not necessarily something that I'm pursuing at this point in time. But these are all things that you need to consider when you're looking at different asset classes. And one thing that you'll notice from this slide is that there's a common theme of needing a good location and a good tenant within those different types of assets. So one of the assets that we have ultimately come back to time and time again and have invested more of our real estate portfolio towards is multifamily. Multifamily is a basic human need. Basically, at this point in time, none of us can live on the internet, unlike shopping and working remote and all that good stuff. So it's something that we'll always need as a community. And so we look at this as a very positive aspect of our portfolio. My own personal opinion is, based on my real estate goals, is that these are the types of assets that we've been focused on. There's volatility across all markets right now, and multifamily has also proven to outperform other asset classes during these times. So people will always need a place to live, as I said, and it serves as a good hedge against the inflationary environment that we've been in. And what that happens when you're in the right markets and you have the right type of leverage and metrics associated with your deal. Bear with me 1 minute. My screen appears to be frozen. So over the experiences that that I've had over the last several years of investing in real estate, I came up with a few pillars of what I consider to be good indicators for an overall investment opportunity. So once you know what assets you want to invest in, that we've, all the different asset types that we just discussed, the next question that you should be asking yourself is, how do I know it's a good deal? I've invested, as I said, over many years across many different properties and asset classes, and I've had some really good experiences and some not so good experiences through these investments. But based on what I've had, I've come up with what I think the 3 overall pillars to consider are in any real estate investment opportunity. And the first one is the market. So investing in the right locations and strong markets can really help mitigate your overall investment risk. That's one thing that I've seen in the properties that I've invested in. The second item associated with any opportunity are the deal itself and its financial projections. So, a lot of people put a lot of focus on that. And there's some really interesting research out there that the higher overall projected return that is shown on an investment, the less due diligence people actually do when investing in that asset. So I like to think of it as trusting but verifying the financial data. And we'll go through some of the red flags to be on the lookout for in terms of the financial projections associated with any opportunity that you come across. And the last pillar is the team. And so this is one that I think often gets overlooked, but the sponsorship team is critical to the overall execution of the business plan and ultimately the success of your investment. So next thing we're going to look at is how to dig in and how to look at these pillars associated with each of these areas. So the first area that I look at, the first pillar that I mentioned, is the market itself. Investing in a strong market with some of these metrics that we're going to talk about, as I said, reduces your overall investment risk. Good markets are basically areas that meet multiple facets of the attributes on the screen. So I like to focus on markets where there's a significant amount of population growth. If people are moving there, ultimately, in the multifamily assets that we've been focused on, if people are moving to that area, there's a lot of job growth. It's an area where people are always going to want to invest in real estate. So when you ultimately execute your business plan and you go to either refinance or sell the property, there's always going to be a market of buyers out there because you're in a strong growth market. So we look for these markets to have population growth, overall job growth within that particular area, employment industry diversity. And so what this means is basically we make sure that the population isn't overly employed by one particular industry. So if that industry has any sort of disruption, that the employment and the jobs and the wages will go down associated with that disruption associated with that industry. So we like to be no more than 20% within one industry, just to make sure that we're mitigating risk associated with any job loss. We try to focus on markets that are landlord friendly. That's one of our number 1 criteria. And that reason being is if someone's not paying their rent or they are not performing along the lines of their contract with the property, we want to make sure that we have the ability to evict that person. And if they are not abiding by their rent schedule and they're delinquent, and we want to make sure that we have that control and invest in states that will be more landlord friendly as opposed to being tenant friendly. And again, we want to focus on areas where there's good schools, there's less crime, because that's just increasing your marketability of your property. It's going to allow you to increase your operating income and also give you a higher basis for a buyer pool when you go to sell that property. So one thing I wanted to give to the group here is, what are some resources that you can look at to consider the strength of a market? So if you're presented with an opportunity to invest in a property, how can you look at that market and know whether it's a good market to invest in? So here are some free resources that investors can use to gauge market strength. One of my favorite sites to go to is niche.com, and that will tell you the strength of the schools in that area. It'll tell you the average household income of an individual in that area, and several rankings. So if it's, ranked number 3 in the state for overall highest wages, it'll list all the rankings associated with that particular area. And so that, again, goes back to how successful your investment will be in, having the right type of tenant base. So if you're trying to increase rents and reposition a property when you purchase it, you want to make sure that the income level is sufficient within the tenant base that you're appealing to, that they can actually afford that level of rent. Another one is the Census Bureau, and that will provide the unemployment rate for the particular area. And again, that just goes back to the overall job growth and industry viability compared to the overall US unemployment rate and compared to other areas you might want to invest. The Labor Bureau has a lot of information about jobs and employment that you can use. And the bestplaces.net is another source that I use pretty often. And that has information on crime levels, schools, school rankings, and the amount of housing that has been constructed in that particular area in recent years. And another one that's a paid, there are some free reports on Neighborhood Scout, but there's also some where you can actually pay to see a lot of granular detail on a particular market and area. But these are all areas that I review as an investor before I passively invest into any deal, or before I purchase a property through my company. We always vet all of our areas. If we don't have someone, if we're not physically located there, we will travel to the market and make sure that it's a place that we want to be invested in. We'll do a lot of due diligence around that market. We typically have what I call boots on the ground. So we'll have someone on our team actually be physically located within that market, so we can know whether it's a good area to be invested in. The next piece the next pillar that you should look at, and where I think a lot of people tend to focus on. I mean, as a finance and accounting person, when I first started investing, I am guilty of just jumping right to the projections associated with an opportunity and not focusing more on the other facets and some of the risk factors associated with some of the projections. So these are 3 areas that I think every investor needs to focus on when they're investing into an opportunity. These are some of the areas where, if the assumptions or the metrics are too aggressive, the projections and the returns, in my opinion, are essentially meaningless. So there's more risk associated with these types of deals if there are not sound structures in place and sound assumptions associated with performance. So the first thing I talk about is just the overall debt structure. So how a deal is being funded from a debt perspective, when you're purchasing the property, the largest amount of funds utilized is through debt. And so many inexperienced investors don't focus on how the debt is structured and what the loan to value is associated with that property. So if you're getting you're purchasing $100 million property, say it's a large multifamily property, and you are you're obtaining $60 million in debt, your overall loan to value ratio is 60%, so 60 over 100. And the reality, the reason why we want to look at stats like that is the reality is most of the less attractive investments will have very aggressive debt structures. The higher that LTV, that loan to value is, the higher that percentage is, the more risk you have associated with your investment. And the second item that I always look at is I want to make sure that there's a preferred return as a passive investor. So the preferred returns, that really aligns the interests of the overall acquisition and the opportunity so that the investors can get a preferred distribution on the cash flow. It aligns the passive investors with the overall sponsorship team. And you want to make sure that you get a preferred rate of return before that sponsorship team receives any cash flow associated with the deal. So that minimum preferred return is what you want to make sure that you have, that is incorporated into the investment. And lastly, there's some key assumptions I like to tell folks to take a look at, like in rent projections, something we call capitalization rates. And that's basically just your operating income over a value of a property. And then any refinance assumptions are key to the reliability of the financial projections. And so what I'm going to do here is just talk about some of the red flags you can be on the lookout for when you're reviewing an investment opportunity. And so we talked about the debt structure and some of the red flags that you want to avoid when you are when you're reviewing an investment and you're determining whether or not you want to participate is you want to look out for that loan to property value percentage. You know, typically when interest rates were lower than they have been in the past 6 months, we were targeting properties that had a max of 75% loan to value. Now that interest rates have risen and there's a little bit more risk associated with the interest rate hikes, we're targeting properties that are more along the lines of 60 to 65% of a loan to value. So that's one area you should review and be on the lookout for. What's your interest rate risk associated with the debt? So if it's a variable rate, do they have an interest rate cap? That's often offered associated with variable debt, or do they have interest rate reserves? So if interest rates continue to rise over the next year, do they have reserves associated with that property if they do not have an interest rate cap? And lastly, the liquidity. How long, for me, it's that it'll take to get your investment back. So based on my investing strategy at this point, again, only my own personal opinion, I'm looking for my capital to be working as quickly for me as it can. So I want to have a shorter hold period. I typically, invest in areas that in properties that have 3 to 5 year projected hold time frames. I want my capital back as quickly as possible so that I can redeploy it and overall just try to aim to maximize that wealth accumulation. And the next area that we talked about and a few red flags to be on the lookout for is make sure that every deal you invest in has a preferred rate of return for its passive investors. And again, that preferred rate of return is the cash flows that come from the property, the overall returns associated with the property that's the minimum that you will receive before the sponsorship team gets paid anything on that particular asset. And you also want to avoid preferred returns with the general partner catch-up provision. That just means that there's certain instances in which the sponsorship team can participate in that first level of preferred return. And so you want to make sure that that preferred return is geared towards the passive investor. And lastly, there's the key assumptions that we want to make sure that the sponsor is making reasonable assumptions for. The first of which in the assets that I invest heavily in are multifamily assets are the rent projections. So are they reasonable? We've seen some record levels of inflation, some record levels of rent increases as well as home price value increases over the last several years. And so you want to make sure that with the Fed trying to tame inflation, that the rent growth projections associated with any deal are reasonable, and that they're not continuing to predict that we'll have 10%, 15%, 20% rent increases as we've had in several markets over the last several years. You also want to look at what is their projection for the valuation of the property upon exit. How does it correlate to the increase in income of the property during the time that you held it? So a lot of assets that we purchase are assets where we do a value add, we execute a value add business plan. And what that means is basically we will purchase the property that has, an opportunity, maybe it hasn't been renovated in the last 5 to 10 years. And we will go in, perform renovations, and we will increase rents, or we'll add some amenities. We'll improve upon the exterior appearance of the property, and that will increase our operating income. And so you want to look at what the sponsorship team purchased the property for, and ultimately what they are projecting that they will sell that property for. And does it appear to be reasonable based on the amount of income growth that the property has seen throughout that time frame? You also want to try to avoid any investment opportunities where they have a refinance assumption. So with the debt market being a bit unclear at the moment, and with no one that I know of having a crystal ball, I don't like to invest in anything that assumes that they will need a refinance in order to return capital. You want to make sure that they are assuming that the overall debt structure and the current capital stack associated with the investment will remain relatively straight line throughout the investment time period. And the last pillar that we look at are the sponsorship team. And in my experience, the team is just as important to the investment as the deal itself. A great team can take an average deal and turn it into a home run because they have that experience, and that they've been able to pivot in multiple market cycles and over a time frame, over several years and time frames that where the market has obviously been at different points. So some of the characteristics of a team are: how many partners are there? What is their track record? How long have they been in, how long have they had a successful background in business? And what's their expectations for longevity in the business? One important thing that I find is how do they communicate with their investor base? So I've invested in a deal in my early stages of investing in multifamily where there was a significant shooting on the property that we were invested in. And I did not find out until a year after the fact. And, we were wondering why there was so many problems with vacancy and issues and tenant turnover. And, I just found the communication to be extremely poor associated with that asset. Now, luckily, the market turned and they were able to focus on repositioning the property. But again, I want to be in the know as to what's happening with the overall property and my investment itself. Another area that I like to look at is, are they personally invested in the project? And again, that just goes back to, are the goals and is there alignment across the property and the investment? And what's their retention rate for investors? How often do they have repeat investors? And if they don't have repeat investors, why don't they have repeat investors? One thing that I think often gets overlooked and that I think is very important is requesting to speak with someone that has invested with that team in the past, and ask them about their experiences and their communication. Every sponsorship team should be willing to do that for you. And if not, then I would run if it were me. So I would ask to speak to someone that has invested with them in the past. Another thing you want to look for is what fees are they charging. So if there's, they have to charge certain fees to manage the asset, you want to look at those fees and make sure they're aligned with industry standards. And so with that, I just wanted to, sort of get back to where this experience and where this journey has taken me. And so with all of the years that we were investing into real estate, I wanted to make it a point to take all of those experiences and, determine all the things that I learned. And I wanted to come to a point where I could create an investor community where we would, offer them opportunities in strong markets. I could utilize this, the three pillars that I've learned over the years in my experiences investing in real estate, and take that and create a team. And so with that, we have a company called One Street Capital. And with those particular, our team has several assets, and we've accumulated over 900 units of multifamily assets. We're about to roll out an ATM machine fund, and we're focused heavily on what we, based on our research and based on our experience, has been to be in recession resilient assets. So that's where we've been focused, and we're just been having just a wonderful time, and really love what we do on a day in, day out basis. So with that, I just wanted to summarize what you can take away from our discussion today and how you can better position yourself to be a better real estate investor, and what steps you can do in performing your due diligence. So you want to, again, know your investment goals before you begin. Know that there are different asset classes and that they serve, each asset class is more heavily geared towards different investment goals. Almost all of these investments have tax benefits. Know the three pillars associated with any offering: the market, the financials, and the team. And remember that strong market dynamics help mitigate the risk associated with investments. Avoid offerings with the financial projection red flags that we discussed. And a strong team is critical to the overall success of any investment. And what I like to do is I like to provide people with my contact information. I'm more than happy to assist. Please feel free to reach out to me should you have any questions or want to know a little bit more about our company, or again, even if you just have questions in general on real estate investments or any of the topics that we talked about today, I'm happy to address. And my email and my website is up on this slide. And that's it. That's all I have for today, Will.
Perfect. Thank you so much for that, Denise. Now we can begin with the Q&A portion of today's presentation. I just would like to remind everybody to use the Q&A function at the bottom of your screen. Type your questions for Denise, or if you have questions about self-direction as well, you can post them. So I'll get us started, Denise. So when did you start investing in real estate, and what was your first asset class?
Sure. So our investment, our first investment was over 10 years ago now, and it was a single family asset. And again, I think it's an easy way for people to get started. That's why I went about investing in single family. However, at the time, it ended up taking up a lot of our time and effort, and it wasn't as passive as I would have liked it to be. So at that point in my career where I was, I wanted to have a little bit more of a hands-off experience and not necessarily have to deal with tenants. So it was still a great investment, great learning experience, but again, not really aligned with where I wanted to be in terms of a time commitment.
Awesome. Another question. Tell us about the last deal you and One Street did. Could you give us some more information about how that worked out?
Sure. So our last deal that we closed back a few months ago in 2022, we acquired a portfolio of properties in Greenville, South Carolina. It's one of my all-time favorite markets. Basically, it's an area where there's been a lot of migration, a lot of population growth, a lot of job growth, and it's just a really great opportunity. And with our team being very conservative in our underwriting, it was a big win for us. We actually acquired the portfolio for with another team for $36 million. It was over 200 units, so that's why the purchase price was so high. And the property was subsequently appraised for over $50 million. So it was a big win for us. We're actually in the process of starting our renovations here in the month of December. And so we are performing renovations on the units, and we're just overall improving the tenant experience. We're painting the exterior of the property. We're focusing on improving our amenities. We're offering a lot of social gatherings and things to promote more of a sense of community at the property, so that because ultimately we want people to be a place where people want to live and spend their time. And we want to retain our tenant base. So we're doing a lot of positive things for the property, especially in the month of December. We're doing a holiday party, we're doing a gift wrapping station, and a lot of good stuff.
Right. Sounds very nice, Denise. We do have another question. It's about self-direction, but it also applies to taxes. I'm not a tax professional, so I'll just answer it to the best of my ability. And Denise, if you have anything you want to add, I would love that.
Sure.
So the question is, what is the best type of investment for self-directed IRAs, considering that we can't take advantage of the tax benefits? So what we like to tell people at Camaplan is to invest in what you know, understand, and can control. So if you're familiar with a specific asset class and you have deals that you've done in the past that you know that you can do out of your self-directed IRA, those will probably be best for the investor themselves. And where there may be a deal where the tax advantages or the tax benefits may not apply to the IRA like they would apply to you personally, the IRA is still a tax sheltered account, and that's the benefit. You're using it to grow your retirement account in either a tax deferred or a post-tax fashion. So you just, whatever your CPA advises, go with that. But there's benefits built into the IRA and its structure.
Yeah, and well, I'm happy to add on it as well. Obviously invest in what, the whole point of today, I would like for people to take away that they should invest in something that they're comfortable with, that they feel as though they understand. And, the one thing to the tax benefit comment is, we have a lot of people who invest in our assets through a self-directed IRA. And although you don't get the same type of tax benefits at that time, the overall tax strategy of accumulating wealth in this IRA and then ultimately being taxed at a lower rate when you are at a different point in your investing career, in your investment place, and you will be probably taxed at a lower rate. So you can watch your funds accumulate, and you want to target funds that have strong returns and have the attributes, no matter what property type that we talked about today. And the ultimate tax benefit again is realized once you go to extract your funds, and you can ultimately be taxed at that lower rate than maybe you would be if you were still working.
Awesome. Thanks for that additional information. Very helpful. We have another question from Mark. Can I use bonus depreciation inside my ST IRA? My thoughts are that you can't, but I'm not a tax professional. Usually IRAs don't pay taxes except for in some certain instances. Do you have any comment on that? I believe the answer is no, but I could be wrong.
You'll still get the bonus depreciation on your K1 through your IRA, but again, to your point, it's not going to overall reduce your taxable, your taxable income, because this is not income that's being taxed at the time. So you will, get the same type of depreciation that every investor gets when you're investing in a property. It's just that you're not taxed on that income, so you don't necessarily get any sort of benefit associated with it.
Okay, makes much more sense. I appreciate that. Follow-up was, if not, what type of investments would be best? I believe we already touched on, what type of investments to make out of your self-directed IRA. It's basically what you know and can control. Any other questions for Denise or myself while we have her live? All right. Well, I'm glad that you left your contact information up on the screen. I'll give people a few more seconds while I'm going over this. If anybody is watching this and have any questions in the future in the recordings, you can feel free to reach out to Denise here, or you can reference my information at the beginning of the presentation if you have any questions about self-directed IRAs. Denise, would you like to leave off the presentation with anything?
No, just thank you so much for having me. And again, if anyone has any questions or wants to reach out, please feel free to do so. I've got my email is denise@onestreetcapital.com, and our website is onestreetcapital.com.
All right, perfect. Thank you so much, and thank you everybody who attended. And I hope you enjoy the rest of your day. Thank you.
Thank you.